And unfortunately, the rates I read about there or the situations I'm aware of tend to not be very good. And the rates make it hard for your business to make money. You're just really kind of paying them or you're going to end up in a hole. The fintech solutions, again, they're using their own money. They can come up with their own structures. They are fast. Again, they're going to generally be higher rate. Um, but, it's less restrictive. Um, One of the things that says corporate credit tools, but it's really one of the areas I like too now is corporate cards. It's becoming a bigger way to do it. Corporate cards are the Visa, MasterCard, generally American Express. And how a business uses it is they'll charge on the current cycle. So the cycle ends at the 30th of the month. You then have 30 days to pay till the next 30th of the month. And if you pay in that time, you pay the bill down, you don't get any interest. It's a way of adding about 30 days worth of, say, trade credit, equivalent of trade credit. In addition, a lot of these cards are offering rebates. So if you have the discipline and you have the cash flow, it can be an excellent tool. They also have the way they integrate the way their systems work. They integrate with the accounting systems of your business, and they're able to just download straight into it, so you don't have to post the data. That's good. They give you just reports on your spending. The other thing that's going, because these have become more popular, it's not travel, hotel, bars, restaurants that take these cards. It's lumber yards, it's tire merchants, it's a lot of different people are now having to take it because the big companies are forcing payments this way. And so that means more opportunities to generate the sales volume or the volume needed on the card to get decent rebates. So 1 to 2%, depending on what the card is, who it is. You can shop around and find different programs for that. For a large company, it is a very good tool in terms of managing cash flow, but also just getting reporting done. A lot of them have expense reports solutions integrated in the system so that their people can do the expense reports and get approval directly. So that's a good financing option. Let's go back to the banks for a little bit. As I started to mention, the big banks, they are more of the factory is a way to really kind of create a visual for you. They want to stamp things. They want you to throw the input in. They're people to gather all the information, throw it in the box, and hopefully something comes out the other end. The decision-making process for years has been centralized. It is using kind of standardized credit procedures. They're really automating a lot of this, and the reason is especially in a small business financing situation, the economics dictate that you can't touch the paper very often. I don't have the ability from a cost standpoint to really offer you a lot of personalized service. Also, another big reason that a lot of stuff gets centralized is consistent lending practices. That's important because bankers haven't always been, my brethren out there haven't always been on the up and up on how they lend. And we saw that out of the 50s to 60s with the redlining. In other words, they would take money from the poor neighborhoods and make loans in the rich neighborhoods. It stifled the development of the poor neighborhoods and let rich neighborhoods, flourish. And the banks got their hands slapped, and there's now regulations we all have to follow called CRA, Community Reinvestment Act, big regulation in the business. But the other part of it was that as the banks went down the road, they started to get sued for discriminatory lending practices. Well, if you're using a statistical-based lending practice, and this is where FICO, when I saw it developed in the 80s, came in. As you start to develop these statistical-based models, decision trees, you now have an argument against these lawsuits that, hey, this is what the portfolio statistics told me I needed to do to make my portfolio fall within my risk parameters. And so it has kind of quashed a lot of the green mail that went on with that. As banks were going in to buy other banks, it was very common for certain community groups to all of a sudden pop up and with their hand out and say, we want to pay off. And that's kind of gone away these days. I'm not saying that there aren't people that object and try and file complaints, but not to the extent they used to. Um, it also keeps it more consistent, but there's still some need to work there. Banks still haven't got all the statistics to be equal in terms of how they lend. The regional banks don't generally invest in the infrastructure to do the credit scoring. So they're going to take time. They're going to talk to you. They're going to find out more about your business. They'll look more in depth at the business and who the person is, the owners. And that can lead to a more, say, customized structure with, say, seasonal over advance, if that's what the type of business you have is. Um, More tailored to your needs. The difference in approval rates are the big banks' estimates vary from about the 20 to 50%. Depending on which reports you read, the feds are saying around the 30-40% for big banks, and it goes up. The approval rates are much higher on the regional and community banks in terms of getting your credit request done at the 50+%, 52, 57%. Um, and so the feds, it's very clear the regional banks they're able to take into account the character of the person a little bit more because they know the market. They're in it every day. And one of the things when you're looking for a loan is that I've mentioned several types of loans, and it is to match what your need is. The first question I asked myself if I was going out to borrow money is, can I make money with the money I'm borrowing? A lot of people don't ask themselves that. It makes the rate a little more insignificant because if I can still make money, take advantage. Do I have an opportunity to, expand my business? Do I have an opportunity to acquire new customers? Do I have an opportunity to put out a new product line, something that will make me money, and it takes capital, and I need to borrow to get it? Well, okay, am I going to earn enough money to pay the bank back? Am I going to earn enough money to get a return from me? Next is, okay, what lender would I go to? And this chart here kind of, it's what their speed is of what it is. Credit unions are going to be, again, smaller. They're going to be doing a full underwriting. The fintechs, they're doing credit scoring. They're using AI. They're doing a lot of things. So their turnarounds are generally very fast. And you can see just the flexibility. The big banks are going to be much more standard product, take it or leave it. The regional banks, well, okay, we could do this. If you do this, we'll do that. More give and take on how they structure it. And the credit unions are still learning, and the fintechs, well, they can customize a lot of things since they don't care who the people looking over their shoulders aren't bank regulators. And the big national banks will try for a relationship. When we talk about relationship debt, they generally, you're going to go to a branch and here's kind of our standardized product offering. I'm a banker, I can do it all type approach. Not necessarily true. The community banks are more likely to have you meet senior management, more people, the operations people, the credit people in the bank get to know you. So your chances of actually having a relationship so that, you've got this opportunity to acquire another business that happens overnight and you need a fast reaction from the bank, the regional bank is more likely to give that to you in a timely fashion than the big bank. The credit union, again, you're going to be a big fish in a small pond, and again, they're going to be paying attention to you. The fintech, it's just add another number. Let's move on to the next deal. Again, the banks, big national banks, lending limits come in when we say deal size is why this is a little different. It's based on your asset size. It's based on how big the bank is, and it's a percentage of the capital. So a $2 billion bank might have a $10 million limit, and not necessarily a legal lending limit, but a limit that they like to hold in their portfolio. They have to manage the portfolio. Where if I go to B of A, I go to US Bank, I go to PNC, I go into one of the large banks, I'm going to be able to do the $500 million deals. Wells Fargo started that trend. They'll write the check for $400, $500 million deals. They used to have a lot more lower limits, but those have gone away in the last 10 years. And again, it's just kind of repeating the same things I've been talking about and choosing the right lender. But the word you're first starting to see here is risk, and that's a big word. And it's how much are you willing to take on? How much does that align with their portfolio, with their profile? You want to kind of get to the right lender up front. What happens is that a lot of people will go to a lot of places, and then it becomes confusing because all these lenders promise you they can do it, they can't, and you get overwhelmed with information. It kind of freezes the process. You keep waiting for someone else and their response. Well, I want to make sure that they get a chance to respond, and I'm still waiting for so and so to come back, and your deal slows down, and you don't get the financing in a timely fashion. If you go to the three lenders, let's say, start it off right, and you do it quickly, it will go much faster, much less confusion, much less chaos. And the growth stage. Are you a startup? You have different type of financing for a startup, and then are you a mature business? And the startup, you're going to have a lot more equity. It's a lot more risk to it than, say, a business that's been around for 30 or 40 years. It's on the second generation, and it's got a solid balance sheet. All right. So we're talking about financing. And I think it's important to talk about that the balance sheet. I think it's important to talk there because these types of financing fall out in different places of the balance sheet. And that has a significant impact on your business. It has a significant impact on your qualifying. It has a significant impact on your exit. So the assets, which we talk about those because, that's kind of your collateral. Knowing what's in your assets is important, especially particularly with, say, AR, your accounts receivable. Bank debt it goes on the liability side, and it is generally referred to as senior debt.